Hey everyone, welcome to the September Arca crypto market call. For those who are new to this, we've been doing this now, I don't know, 6 or 7 months. The goal is, even though Arca does a lot of content and educational material on markets, um, when we were first getting started 6, 7 years ago in crypto, really had to kind of dumb everything down, really be more explanatory about kind of what blockchain is, what crypto is. As the market has evolved, as our investor base has evolved, as the entire industry has evolved, there seemed to be sort of a void in terms of real analysis, real information on what's really driving the markets, what we're looking at, as well as giving a shout out to all the great firms out there who provide great research and insights and data that we at Arca use for our investments, and I think that others would want to utilize as well. So in short, there's a ton of data out there. A lot of people don't know how to extract that, but market participants are now savvy enough to understand the nuances, and we aim to do that for you. So we'll get started here in a second with September, but first, a quick disclaimer. This commentary is provided as general information only and is no way intended as investment advice, investment research, legal advice, tax advice, etc. But hopefully we can still glean some insights into the digital assets markets and what's happening. So with that said, um, we really try to get in the weeds of digital assets and specific blockchain related drivers of the markets. It's been really hard the last couple of months, though, and August was no different. I mean, this has really become 100% driven by macro forces, by regulatory forces, by upcoming political forces with the U.S. election, as well as just overall kind of technical issues that happen in the market, which is really what we saw um, in August. So to start with, most of you probably saw that August had some incredible volatility really in the first week of the month, driven by the unwind of the yen carry trade. Hopefully you were on vacation, you didn't even realize it because most of the capital markets actually rebounded perfectly. Basically, you had this massive move on August 5th, where you had a lot of leverage being sucked out of the system. Goldman Sachs said actually that it was the biggest deleveraging event of their prime brokerage hedge fund clients in over 10 years, simply because of the yen carry trade. The Nikkei index fell 12% in one day and over 20% in 3 days. The VIX spiked, the fourth highest spike since the late 80s, and only comparable to the financial crisis in 2008 and COVID in 2020. Everything blew out. You had NASDAQ futures were down 7% Sunday night ahead of the Monday, August 6th open. And yet everything bounced back. If you actually looked month over month in August, nothing even changed. In fact, the VIX was even lower overall in the month. Equities were higher, really was sort of a technical blip. And as a result, everything rebounded, right? If you were to buy fear, which you are almost always supposed to do, you would have made money in just about everything that you bought, except, as we'll see on the last slide, crypto. Digital assets just didn't get the memo and didn't bounce back. On the next slide, please. It just didn't bounce back, right? So you had this huge move lower. Everything was a screaming buy. Everything bounced back except for crypto. And why is that, right? Why is this happening? I think the real answer is simply, most of the time when you see sort of a blip move or something that is just kind of completely technical in nature and more about positioning than it is about anything else, it tends to just expose what was already out there, right? So for the equity markets, the bond markets, the options markets, there were already strong demand. This was just a blip that anybody could see through. But for crypto, leading into that, there really just wasn't demand already, and there's just not natural buyers of crypto right now. You don't get the same coupon payments being reinvested like you do in the bond market. You don't have the same dividend being reinvested like you do in the equity market. You don't have monthly new demand from 401ks. So really, that blip on August 5th just exposed what was already a pretty weak crypto market, sent it down on the technical reasons, but not enough real demand to send it back higher. And you can see pretty much everything in crypto well below where it was pre that August 5th crash, even as, again, everything else sort of bounced back. So why did we even have this kind of vol implosion in the first place? What was happening? Well, to start with, you should start to have some real fears of a recession, right? We spent most of the last 2.5 years focused purely on inflation and whether or not that was going to be under control. starting in 2021 and into 22, you had the largest rate hiking regime from the Fed in basically 20 plus years, actually probably closer to 40 years if you go back to the 1980s. And then in the last 4 to 5 months, it's really flipped from, okay, inflation's under control, but now how bad is the economy, right? Is the Fed going to be too late when they start to cut rates? You know, rate cuts can have a really positive effect on markets. If it's done in a soft landing scenario before there's a recession, it can have a really negative effect on markets if the Fed is too late and they're cutting aggressively because things have already gotten under control. So when you had some soft labor and employment data, as well as some mixed other economic data like PMI, it started to freak the markets out. And this is probably the best chart to show that. Every single time you've seen an uninversion of the rate curve, meaning 2s10s or 2s30s, whatever you're looking at, when you start to see that start to uninvert, meaning that the 10-year rate is higher than the 2-year rate, that has always been an indicator of a recession coming. Now, the flip side of that is if there really is a soft landing scenario and the Fed cuts rates and you don't have a recession, the curve would be uninverted anyway, right? In stronger periods of economic growth, you tend to have longer rates higher than shorter rates anyway. So even though this has been a near perfect indicator of the start of recessions, it's also would be a perfect indicator of a soft landing as well. So hard to see, hard to say for sure, but certainly the market is keying in on this. In terms of what it means for crypto prices, though, you know, in a vacuum, lower rates are better for crypto, right? You are more incentivized to hold your money on chain if you aren't giving up the opportunity cost of yields everywhere. So right now, if you hold a stable coin and you're giving all the profits to Circle and Tether, and you're getting nothing by holding the stable coin, it's a pretty high opportunity cost when you can get 4 to 5% rates elsewhere. If rates start to normalize down to 2.5, 3% in the front end again, less of an opportunity cost, easier to hold assets on chain. And once you're on chain, you're doing other things like investing in the market. So all else equal, rate cuts definitely, in theory, better for crypto. So looking at the next slide here, are we going to see 25 or are we going to see 50? Again, I know most people signed up for the crypto markets not to just become wedded to every Fed decision and every, Thursday jobless claim number. But, again, unfortunately, that's just the environment we're in right now. It seems pretty certain that you're going to get 25 bips at this point next week at the September meeting. There's no real indication or need for a panic cut. There's no real indication that 50 would be justified or necessary. CME options markets are pricing in basically a full, almost 100% chance now of 25 bips after the most recent CPI and PPI numbers and jobless claims numbers that just came out this morning. So we'll see that in the horizon, and we'll see how markets lead to that. The weird part, of course, going to the next slide here, is that any of this is even happening in an election year, right? The Fed tries to be independent. They try to be neutral. Who knows if you believe in that or not, but it is weird to have the start of a rate cut campaign right before an election. The crypto market definitely does care about the election. We've been following the price of Bitcoin as a proxy for the market, along with the odds on Polymarket of Trump winning. I think this is probably the most important area to understand in crypto right now, is that ultimately the future success of blockchain and digital assets in crypto has nothing to do with what happens on the election day. But there's no doubt that the market is viewing a Republican win as very favorable for crypto and a Democrat win to be very negative, simply because the status quo, if the Democrats win, would be continue to see Warren in power and Gensler in power and all of the pretty hostile actions towards the digital asset markets. If there is, no change in the status quo, whereas, not only has Trump been fairly pro crypto, but even if he wasn't as adamant about using crypto as a piece to get ahead in the election voting, any sort of a change from the status quo would be viewed positively. In general, if you look back 4 years ago and 8 years ago, after an election happens, regardless of who wins, markets tend to go higher simply because markets hate uncertainty more than they care about outcomes. So once you remove any uncertainty and you actually have a sitting president, assuming that there is a peaceful transfer of power, you will almost always see markets go higher, and I don't think crypto will be any exception. But there's no doubt that how Trump polls right now on Polymarket and elsewhere is certainly driving markets leading up to the election. We found this next graph courtesy of Syncrasy Capital. Thought it was pretty interesting, kind of talking about where we are. Truthfully, I've never been a huge believer of any of these kind of business cycle graphs or any of these sort of made up lines to explain where we are. But if you are a believer in sort of this idea of hype, and then too much hype, and then a crash, and then too much despair, and then ultimately growth, um, you can see kind of where certain sectors of the market really are right now, right? I mean, Bitcoin certainly was the first use of blockchain. It went through that hype cycle, and then that disillusionment cycle, and then ultimately, steady growth. But you can see kind of each sector and each theme that has hit along the last 7 years, sort of following that same one, from layer one protocols to stable coins, who I think, if you had to pick four areas of the market that have undeniably proven product market fit, it has been basically Bitcoin as a store of value, layer ones as an app store, stable coins as a true medium of exchange, and DeFi in terms of on-chain and online banking. It'll be interesting to see if any of these other sectors that emerged a little bit later sort of tend to see that same growth. I would argue that maybe DePIN is misplaced on this graph, probably still pretty early. NFTs, probably still pretty early. Gaming, you could argue, is actually further along and just hasn't actually succeeded as much as you would have thought based on where it is. But certainly new sectors, decentralized AI, things like BitTensor, some of the growth in RWAs, currently just being treasuries on chain, but ultimately can be anything from equities to, real estate to hard assets, and even some of the social fi that we're seeing. Maybe we'll come back to this graph in a few months and see if you start to see some of these sectors move along the graph. Where we have, speaking of DeFi being one of the kind of tried and true sectors that have done well, this has been really interesting. And if, no doubt that on-chain activity is way down right now. And that doesn't seem to actually all blockchain activity, whether it's on-chain or via sexes, centralized exchanges, has been down. But what has been really interesting is in the aftermath of 2022, when so many market makers and lenders were blown out of the market, either from fraudulent activities or just not profitable anymore, or whatever the case may be. The crash of 2022, when you start to see some green shoots and start to see some things reemerging, it's natural to see it on chain happen faster than off chain. And we're seeing that really clearly on Aave specifically, as well as some of the others, that there's a lot of demand right now for on chain loans. And it's nice to see this graph kind of up and to the right. Clearly, when the market was straight down in 2022, not only was collateral getting blown out, not only were there large liquidations, but people were more hesitant to take bullish bets. Now, as markets have calmed for the last 18 months, even though the last 5 months have been poor, you're starting to see a little bit more, how do I make my assets more productive? Should I be, putting them in an LP pool? Should I be actively lending them out? Should I be borrowing against my assets to do other things? And that steady growth, not only has it made Aave one of the better performing tokens of the last couple months, but also you can really see a replacement from some of these centralized order books and lenders into these on-chain worlds. In fact, skipping ahead 2 slides, if you don't mind, Sumana, this is probably the best way to show it, is that even though, again, all activity is way lower, if we were to show you just a graph of all trading and lending activity, for the most part, it is lower. But what has changed to the upside is that the decentralized exchange volume relative to centralized exchange volume has grown to basically all-time highs. 16% is the all-time high it's ever been. If you're looking at decentralized derivatives, it's still hovering around 1 or 2%. But for spot trading, this was as low as 3 to 5. Really, it was about 1% 4 years ago. Then it was, hovering in the 3 to 5% range. To be up at 16%, it just shows you more and more market participants are really starting to get comfortable using on-chain vehicles to trade and to send assets. And truthfully, I mean, you saw that again on August 5th. Just about every brokerage account, from Fidelity to TD Ameritrade to E-Trade, went down with the volatility, right? This is a continued theme that we're seeing in the centralized brokerage world, is that when you need to trade or need to get your money out the most is when they continue to break down, right? Coinbase has had many problems with that as well. Same with Binance. August 5th should have been one of the biggest onboarding days in on-chain DeFi history if the regulators would allow you to do what these rails were meant to do, right? Imagine if you're like, hey, it's August 5th, the volatility is crazy, the Nikkei is down 12%, Nasdaq futures are down 7. I want to go trade Apple or Nvidia. I want to go trade bonds, and all of your brokerage accounts are just down. Well, if you could take those assets, you could take your Apple stock or your Tesla stock or your Nvidia stock and move it on chain into a DeFi rails and still trade it with a seamless experience with no middlemen and no downtime. That would be a home run, right? Again, that should have been one of the biggest onboarding days in DeFi history, but it doesn't happen, largely because the regulators continue to make this impossible to do. But you can certainly see where we're going with this as you see graphs like this showing, and courtesy of the block here, showing how much more activity is moving on chain from centralized order books. Moving back up a slide here, sorry for going out of order. You can see this is just sort of a heat map of market share of the perpetual derivatives exchanges, right? This being not spot volume, but being the derivatives, your futures and options. The big takeaway here is that there's a lot of competition here, right? And so similar to how Uniswap has a massive lead in on-chain spot volume, even though there's been competitors, Uniswap's been able to hold it off. In the decentralized derivatives world, it hasn't been the case. You basically Synthetics was first, and that didn't hold its lead. Even BitMEX, if you want to go centralized, that didn't hold its lead. Then DYDX had a massive lead at one point, doing 70% of all on-chain derivatives. Now they're down to only 10%. You've got Hyperliquid and some others jumping in. So this is probably the most interesting thing as you start to see growth on chain is that, are these incumbents going to hold their leads, or are there going to be new entrants that have, via better products or better incentives that continue to try to take market share here? So again, we're not seeing it really in lending. Aave has a massive lead. We're not seeing it really in spot. Uniswap has a massive lead, but this is where the real fight is, and ultimately where some interesting investment opportunities might come about. Moving ahead here, and again, we're going to have a little lighter on the slides this month than others, just given August was a pretty slow month. But one thing we definitely saw slow in August for sure was Solana. Solana really is sort of the market darling right now in the layer one blockchain world, certainly relative to Ethereum. Some for good reasons, certainly faster, cheaper, certainly has a lot of really interesting things built on it. But also partly because the meme coin hype in the middle of this year really drove the majority of Solana's growth and fees. And as meme coins have really been hit hard in the last 3 or 4 months, you can see that a lot of the hype on Solana has died down, as well as the fee generation. Fee generation is sort of a mixed bag in terms of a metric that you really want to look at. In the sense that ultimately all fee-based businesses tend to trend towards zero, and ultimately you don't want super high fees. You want to get fees lower so it becomes more usable. But still, as a proxy for kind of overall demand and usage, you can see Solana really trending in the wrong direction here. And I don't mean to pick on Solana, but over the last 3-4 months, Solana has been one of the things we've talked about the most as being sort of a leader in the growth of blockchain, and certainly not seeing that right now. That being said, I think if you go to the next slide here, again, fees maybe not necessarily the best way to look at some of these blockchains. Maybe you want to look more at, user growth rather than revenue growth. And shout out to Token Terminal, who does a great job with both. But you can see Solana and Tron and Base really just continuing to have the largest growth in users and daily active users. So Tron really taking advantage of the fact that it has a dominant share in stablecoin usage, specifically Tether on Tron. Base, obviously being built by Coinbase, has a huge advantage with the API connectivity and the user base it already has. And then Solana, again, even though a lot of the activity has died with some of the meme trading, certainly a leader in DePIN and generating certainly a lot of interest there with apps like Hive Mapper and Helium, as well as others. Moving ahead here, I mentioned Base a second ago, and shout out to our own Joey Reinberg at our Arca, who, if you read our blogs as well, I think a couple of weeks ago on our That's Our 2 Satoshi blog, did a great job talking about why Base is becoming the layer 2 of choice for developers and users. A big part of it really being just, again, when you have a massive user base like Coinbase has, and you have all this API connectivity, it's really easy for developers to build on there, and it's certainly easier for users to port over there in an EVM compatible way. You can see here, just in terms of active users, just that blue line being Base, just how much Base has destroyed all of the other Ethereum-based layer twos. So, Optimism barely even on the map here, Arbitrum getting absolutely crushed in terms of relative users, and Base just continuing to go up and to the right. So, it's certainly a market right now where there's a lot of Ethereum hate and there's a lot of concern with whether or not layer twos are cannibalizing the usage of Ethereum. I just don't think that really makes a whole lot of economic sense. The reality is, the layer twos are ultimately paying Ethereum, and if the layer twos grow, then Ethereum will grow as well. But certainly, there's too many of these layer twos, and ultimately, the market is going to decide which one is going to be utilized the most. And right now, it appears that Base is going to have a commanding lead and probably unlikely to give that up. So, moving on here, again, we want to focus more on actual apps. Like August was really slow. There wasn't much, but one um, that really has picked up in terms of real world adoption is Helium. Not only has the HNT token been a top performer in the last couple of months, but certainly in terms of real adoption and real subscriber growth, having connectivity with multiple wireless carriers, having a low price plan. This is really kind of why we get excited about DePIN, not Helium necessarily specifically, but the idea of DePIN is that you can essentially bootstrap a network with tokens faster than anything we've ever seen, right? What you're doing is you're basically building the supply side first. In Helium's case, you're incentivizing people to set up mobile hotspots. In the Hive Mapper case that I mentioned, which has a token Honey, you're incentivizing people to essentially recreate Google Maps by putting these devices in your car and mapping the world as you drive. But these supply side incentives to build out a network eventually need to be met with demand. And we hadn't really seen that yet. But for the first time, we're starting to actually see that with Helium, where the actual demand side is starting to catch up, right? An analogy I like to use is, imagine if there was just a massive tax and government incentive to build bowling alleys. Everybody would build a bowling alley. It'd be free to do. You could build all the bowling alleys in the world, but eventually somebody has to say, you know what, I actually like bowling and I want to go to a bowling alley and I want to use it, right? All the supply in the world doesn't generate demand. Ultimately, you have to generate that demand side as well. And I think that's where DePIN really is right now. Maybe going back to that curve we showed a few slides ago, is the supply side is built out. The supply side is definitely built out at this point, and you just need to figure out if you can actually get the demand as well to make it worthwhile. So, congrats to Helium for the recent success, and others hopefully follow the same adoption curve as well. So with that, we'll end it there. As always, you can read all of the other content we're putting out on our website, ar.ca. Certainly for those who are interested in learning more about Arca's products, you know how to find us, info@ar.ca. And certainly you can follow us on all of our social channels. September tends to be, at least historically, a negative month for crypto prices. Fairly unchanged to start here, but expecting a little volatility over the next 2 months ahead of the presidential elections. Hopefully with a little bit more to talk about in the coming months. So as always, thank you for joining us, and we'll see you next month.